Hello everyone, let us continue with our discussion. So previously we have discussed 2 points in minute detail. One was regarding the framework for the capital market expectation, and then we have also discussed about the problems in the forecasting. Means you have to forecast the future. So in that forecasting, in the process of forecasting, what were the issues? Clear? Now forecasting also includes the growth of the company, growth of the economy, clear growth of the global GDP. Means it's not about my country. I'm also dependent upon other countries as well. So how the other countries are also growing, clear? So now the focus in this particular lecture is going towards the trend rate of growth. Give the heading the trend rate of growth. So over here we are going to study about the economic growth and the exogenous growth. Clear? So my point over here is to help you to understand that how this exogenous shock, okay, they are going to affect the economic growth trend. Clear? My first and the foremost point to be discussed is what is economic growth, because then only we will see now that how something can impact my economic growth. Clear? So economic growth means how much a country's production and income increases over time. Clear? Either you increase your income, also you increase your production, or both, either of them. Sir, how can we increase the income without producing? Sometimes it happens that your company is in US, clear, but they have factories and offices and branches are in India. So they are selling their goods. Now they are sending the remittance back to India, like McDonald's. McDonald's is selling the burgers in India, 100 rupees burger, out of which 30% is the commission of the McDonald's owner. So that 30% will be transferred to US. So for the US, it's without producing anything, they are generating the revenue. So either you increase your income or you increase your production, or both over time. Clear? Now you can see that it has two main parts. One is cyclical variations, another one is the growth trend. See, when I'm using the word growth trend, it is a long term direction for the economy. I'm talking about the long term. When I'm talking about the growth trend, say for 50 to 20 years, like if I'll see the growth trend of India in the last 20 years versus China versus Sri Lanka versus Bangladesh versus US versus Brazil, like this. Clear? Cyclical variation, short term, up and down, like recession, okay, recovery, cyclical variation, what is happening in a short period of time. Are you clear? So now which one is more important to you, short term or long term? See, when you are looking at from the capital market expectation perspective, so for you long term is important. Clear? Because that's where the investors are concerned, and that's what the policy makers care about. They're not worried about what will happen in the 3 months. They are worried about what will happen in the next 3 years, 6 years, 9 years, 12 years, or 15 years down the line. Clear? Now coming to the next term is your exogenous shock. What is exogenous shock? Exogenous means what? An unexpected event which is coming from outside. My country is doing everything is normal, but there is a war between Russia and Ukraine. It impacted the oil pricing. I am the one who import huge amount of oil. So this shock is coming from outside my country and it is completely unexpected. Clear? So when I'm using the word exogenous, the meaning of the term exogenous is from outside the normal working of a economy. Clear? Shock, exogenous shock coming from outside. Shock means something which is sudden, something which is, I call it as an unexpected event. You cannot predict it. Okay, it's not the part of the market, but it happened unexpectedly. Clear? So these events are not predicted, and they are not included in the current market price. So market do not expect them. Clear? So when they happen, they disturbs the economy as a whole. So hopefully now you understood 2 points of this LOS. Sir, what is economic growth and how the exogenous stocks will impact my economic growth. Clear? Now, a general question which student generally ask, sir, why are these stocks important? Sir, why we are actually teaching this? See, they can change the long-term path of the economic growth. Means normally the way we are moving, there is a chance it can disrupt the economy as a whole. Like you will take the example of a Ukraine. Okay, their economy was growing like this, but now sudden war and it came down. Clear? So this sometimes can cause a complete regime change, means the entire pattern or the structure of the economy will get changed because of this exogenous shocks which are coming from outside. So they can also hurt us. Clear? Because see, if you might have think, just I will give you one example. You might have seen or not, I don't know, TCS. Before the Ukraine war, okay, this war actually have happened, the price of the TCS was 3800 per share. It tends to increase. It was in an increasing trend. Clear? But because of this war, recession happened, inflation happened, so many things have happened, and because of which the share price shrink to 3000. Then again it went to 4500 approx. Now again it came back to 3000 because of so much of economic changes outside India. US have imposed the tariffs, H1B visa fees. So now most of the money is coming from outside India. They are heavily dependent upon outside India. So you see how the regime have changed for them in the last 4 years. So when you look at the trend, when you look at the graph of the TCS, you will understand that yes, something will happen outside. It will impact the companies inside your country. Clear? So I have just given you one example from which you can relate that yes, something is happening naturally. Clear? Now the point of discussion is, sir, from where these exogenous shocks are actually coming and why they are hurting and how they are hurting. So I am now going to understand the 6 sources of exogenous shocks coming from outside. Clear? Now the first one which you can see on the screen is the changes in government policies. See, government policies can strongly influence the long-term growth. It can be your tax policies, your infrastructure spendings. They can encourage the private businesses. If they will encourage, then economy will boom. If not, economy will shrink. The investment in education or human capital, if the investment is good, economy will grow. Otherwise, economy will be shrinking. Clear? There low interference in the free market. If they will start interfering inside it, it will become difficult to operate. Otherwise, it will become much easier. Clear? So imagine that government will build a multi-lane highway connecting the villages to the big cities. So now the businesses can now transport goods faster to the villages. So what will happen? This will boost the trade, job creations will be there, tourisms will be there, and hence the long-term economic growth can be increased. Clear? Like I'll give you one more example. Like when India have introduced this UPI digital payments, okay, nobody has expected that such big transformation will be there. Small shops are started accepting the digital payments. Now there is more transparency, more transactions. Economy also got pushed. Now money is entering into the bank. Once the banks will get the money, they will start revolving it to the business. Now business will start creating more business. So this is a positive exogenous shock. Now shock is like a volatility. Clear? There's a risk, also there is a possibility of benefit. So the example which I've given you, it's a positive exogenous shock. Clear? So here you can see the point which I mentioned, like a very good fiscal policy, that they are investing a lot into the infrastructures. They are ensuring that even if they can work on the low interest rate so that the business can take the money from the banks, they will do more business, create more jobs, employments, and hence they will produce the goods, they will export it. Clear? They will encourage the private sectors, investments in the infrastructures, better taxation policies, development of the human capital. And the example which I have given to you regarding the UPI digital payments. Clear? Similarly, political events. Okay, if your nation is politically stable, try to understand, it will give you the good growth. But if there is a political tensions, or there are civil wars or war with your neighbors, then economies will slow down. So if two countries will go into the war, money will be diverted to the defense, less money will go to education, hospital, technology, growth will become slow. This is a negative exogenous shock. If I'll talk about positive, if two countries will resolve the conflict, they will reduce the military spending, then that savings can go into the development and the growth will increase. Clear? Like India Pakistan tensions, they always affect the trade and tourism. And whenever the trade rises, foreign investment slows down because foreign company don't feel safe. India and Pakistan is into the war. Might be there is a lockdown inside the country. Might be there is an emergency from the president or the prime minister of India. Then how they will trade? So foreign investments slows down, and you will see its impact in the share market. Clear? As I mentioned in the screen. Coming to the third point, technological progress like steam engines, industrial evolution, computer, internet, mobile phones, AI technology today. So they are actually increasing the productivity, higher the long-term growth. Like earlier, booking a taxi was difficult, but now today, with the help of the Ola and Uber, this transportation become easier. You are able to save your time. You are able to reduce the fuel waste, and hence the result is boost of the economy and long-term growth will increase. Another example is your natural disaster. Point number 4. So the fourth point is about the natural disaster. See, like your earthquake, your floods, cyclones. So they usually reduce your short-term growth because the productions will stop, factories get damaged, people will lose their home. But sometimes rebuilding leads to more efficient infrastructure. Clear? Like after like what happened in Japan. Okay, they got hit by the flood and the earthquake, but now they have developed the flood saving walls. They have developed the buildings in such a way that even if the earthquake will attack us, we'll be safe. So after the cyclone will destroy the old homes, my new home is built are stronger, they are more modern, so long term benefits. Clear? Same happened in Kerala. Flood damaged the infrastructure, but rebuilding brought better bridges, better flood management system. Clear? You can see the points. Short term economic slowdown, but for the long term you are building the better future, like from the earthquake, floods and cyclones, and the example is of the Kerala floods. Now if you will discover the natural resources, means if India suppose find out some natural resources like oil, gas, rare minerals, lithium, gold, silver, then economic growth can increase because these resources will bring money along with the jobs. Like the discovery of the shale oil in the US, they have reduced its dependency on the Middle East, and that have boosted the US energy sector. Like suppose I'm giving you one example. If Bihar will discover a large lithium reserves tomorrow, then huge investments will come, employments will come because they want to extract the lithiums, better roads because you have to get it transported. So the long term growth trend for the Bihar will increase. Clear? Similarly, coming to the sixth point, your financial crisis. So a financial crisis happens when the banking system collapse, or you will lose the confidence in the financial institutions. So people will get scared, they stop investing, and hence the economic slowdown. If you'll ask me some economic history, like US banking crisis in 1930, clear, or the global financial crisis in 2008. So these are the examples of the history where people have lost the trust, but again that trust will be rebuilt. Clear? So imagine in your area a bank suddenly fails due to the fraud, so people will stop trusting the bank, everyone will withdraw the money, new loans will stop, business cannot grow, and the result is economic slowdown, negative exogenous shock. Are you clear? So the point with respect to economic trend and exogenous shock is over. Coming to the next point of discussion. Now this discussion is on your next LOS. Discuss the application of economic growth trend analysis to the formulation of capital market expectation. So now I am touching the economic growth with the formation of capital market expectation. So since beginning, what I am discussing is capital market expectations. It's forecasting, problem is forecasting. We have to include the economic growth, but then a question mark will come. What about the exogenous shock? We understood that. Now they say that, okay, you know economic growth, start putting it into your capital market framework. Clear? Now, just before beginning that portion, I have included three practical examples. Number one is your COVID 2019 pandemic. So that was a global exogenous shock, changed the working pattern, education pattern, healthcare system, and lot more. Then semiconductor shortage, they have slowed down the automobile production globally, and hence the price of the automobiles have increased that year. You remember 2023-24, and the ban of the major apps like TikTok. So digital industry shift was also there. India have banned many apps around the years. So see that this trend rate in the growth is a very important aspect when you are forecasting your capital market. The future of the capital market means how much my economy is going to grow, because then only I'll get to know that, okay, this investment will give me this much amount of returns. So now what I'm focused on, the first and foremost is the long-term average growth rate of the economy. And what I want, it needs to be positive. It needs to be in the increasing trend. Clear? So if you want to forecast the long-term bonds and the equity returns, then this will play the vital role. Otherwise, it is next to impossible that what will happen to the economy after 5 years if you don't know the economic trend. Clear? Whether it is growing or whether it is shrinking. If you don't know, then how you will forecast for the next 5 years, 15 years, or 30 years down the line. Clear? So this trend will ensure that your forecasts are disciplined and your forecasts are realistic in nature. Clear? Like I'll give you one example which I have covered in your point number 2. If you are calculating the growth of the company with the DCF model, discounted cash flow model, then you have to use the growth rate. Clear? If you are forecasting the return, then you have to incorporate the trend rate of the growth. Otherwise, your value will not be consistent with the long-term economic growth. If you put some random numbers or without calculation, if you are putting a number, then it will not make sense. Clear? Like if you look at the third point, higher trend growth, it will impact the market in a positive sense. Clear? So if the stock price today is $100 and I am presuming that the growth rate is 10%, then after 1 year the stock price is going to be 110, provided this is not already priced in. Okay, sometimes it happens that whenever a new information comes to us, we already price that into the stock price. Clear? So if it is not, then this higher trend growth rate will lead to the higher stock price return. This means that economy can now grow faster without triggering the high inflation. Inflation is one of the biggest setbacks for any economy. Clear? Because in that situation, they have to increase the interest rate, and when we will increase the interest rate, it leads to the lower loan disbursal. That means companies are not borrowing, and if they will not borrow, then they will not produce. No economy, no income, unemployment, shrinking of the economy. Clear? So what my focus is, trend rate of growth. Then I know that I'm going to utilize that in the DCF model. Higher trend growth rate means it is going to impact your market in the positive manner. Clear? Now, if there is a higher trend growth, so it actually leads to high government bond yields. Clear? Because now there is a huge demand for the economy, for the money, and the more demand for the money means the interest rate tends to be higher. So now what you want to be stable with respect to a developed economy versus an emerging economy. Developed means like US, UK, or Japan. So they have stable growth trend. Clear? They grow slow but steadily. But emerging economies like India, Brazil, okay, then we have Indonesia, so they grow faster, but it is unpredictable. ठीक है?
तो उसके हिसाब से
Now the question is that why it is happening that emerging economy will have higher growth rate for few years but then slow down, or why it is unpredictable. See, because they are catching up with the developed countries, they are improving their infrastructure, they are trying to increase their productivity, and if anything new will come into the market, any shocks, then they are the one who are not well planned, well prepared for these shocks. So even for them, the slowdown will also be faster. Clear? So how do we forecast the economic growth? So this is a very simple model. We include three factors: labor, capital per worker, and total factor productivity. These are the three important aspects. From here, first of all, moving to this, that influence on monetary policy and the bond yield. Definitely yes sir, if I am into the high trend, high growth rate, interest rate will increase. Clear? So high trend growth, central bank may rise the interest rate. Clear? Leads to the higher government bond yield, and that is linked to the inflation as well. Clear? Then developed economy versus emerging economy. Developed are stable, predictable growth trend, but for the emerging, it's less stable, more volatile, and long period of fast catch up for the growth. Clear? Now, three components which are important. Okay, how we are going to forecast the economic growth: labor, capital, and total factor productivity. Clear? Now, the first point is labor input, means how many people are working and how much the labor force is growing. Means try to understand countries which are growing, they have a huge amount of labor. You take the name India, China, Bangladesh, Pakistan, they all are the one who are producing. So how many people are working? Very big factor. Clear? How much labor force is actually growing? Population growth plus labor participant rate. These two are a very important factor. Clear? Labor participant means if suppose India have population of say 100. Clear? How many actually are choose to work? Like 30%. That means only 30 people of India are actually working. Now, if the labor is working, they need capital, they need machines, they need tools, they technology that will help the workers to produce more. So when workers will have better technology, productivity will increase. Third point is total factor productivity, or in other term you can say efficiency. If you are more efficient, there will be less wastage of resources and more productivity, better management, better government policies, better technology. Clear? So these three factors leads to the growth of the economy: number of labor, how much capital do you have for the labor, and the total factor productivity, that means the level of efficiency. Clear? Now let us take one example. Forecasting the long-term economic growth rate, assuming that the population is expected to grow by 2%. 2% is the rate by which my population is going to grow. Second, labor force participation is expected to grow by 0.25%. So if we are spending new capital and that is also going to grow by 2.5%, means population going to increase by 2%, labor participation is also going to increase. Means earlier suppose 10% of the population is working, but now 10.25, that means higher labor force, higher productivity. Now capital is also going to be increased by 2.5%. Total factor productivity will also grow by 0.5%. So now they are asking me, you need to forecast the long-term capital growth rate. So all these points are going to be added. Add 2 plus 0.25 plus 2.5 and plus 0.5. So my long-term economic growth rate is going to be 5.25%. So I am expecting that the economy will grow by this percentage. Clear? Now we are going to utilize that knowledge of growth in our equity market. See, in the long run, the growth of the total equity is totally dependent upon the GDP growth. Clear? Because the equity value is connected with the nominal GDP, earnings per GDP, and price to earning ratio. Dependent upon three things: nominal GDP, earnings per GDP, earnings per GDP, and price to earnings ratio. Price to earnings ratio. We call this as price by earnings ratio. So over the long period, the earnings share of the GDP and P ratio cannot increase forever. Somewhere it will stop or somewhere it will become stable. Clear? So long-term equity mostly follows the GDP growth. Clear? Apart from the GDP, they also focus on the dividend yield as well. Okay. Dividend yield means what? How much a particular company is actually paying to its shareholders. Means suppose the market value of a company is say 10,000 crores. Clear? Out of which they have paid suppose 1,000 crores to the shareholders in the form of dividends. So what is their dividend yield? Then 10%. 10% is the dividend yield of the particular company. Clear? So it depends upon the payout ratio. Dividends divided by profit as well. Means how much profit you make. Suppose you make the profit of 2,000 crores, out of which you have paid 50% in the form of dividend. So we call this as dividend payout ratio. Clear? Also, we will consider the profit multiples, like market value divided by what is the profit. Suppose profit is 2,000 and the market value is 10,000. That means I am trading at 5x of my profit. Are you clear? So what I am doing, I am connecting the dots, equity and the growth trend, saying that my equity market is solely dependent upon the growth rate. Clear? For better understanding, let us do one thing. Let us solve one question. Okay, then we'll have a good grip over the concepts. Forecasting long run equity return. Cindy Navarro is an equity research analyst for the Evergreen Asset Management firm. She has been asked to produce capital market expectation for asset class in several different markets relevant to the company's renewable green energy funds. Clear? Navarro is aware that long-term GDP trend forecasting is considered the starting point to form the capital market expectation. Correct? In order to make a forecast of trend GDP growth in the domestic economy, Navarro collect the following data. Now they have few information to actually forecast the GDP. The first is, okay, annual labor input growth. How much the labor is actually increasing? How much is their productivity increasing? Inflation in the economy. How much is the dividend yield? Long-term change in profit as a share of profit 0%. Long-term change in the P multiples 0%. So now if you are asking me, sir, what is the real GDP growth? Real GDP growth is coming from these two factors, labor, capital and total productivity. So capital is missing. So we have only two elements. So what I'll do, simply add 0.4 plus 1.4. That means 1.8% is my real GDP growth rate. Clear? Now, if I want to calculate the nominal GDP growth rate, then what I'll do? Real plus inflation. So how much is the inflation? 3.8. So 1.8 plus 3.8 is equivalent to 5.6%. 5.6% is the nominal GDP growth rate. Now, long-term capital gain in the equity market. So how you will calculate that long-term capital gain in equity market? So write down long-term capital gain in equity market. Long-term capital gain in equity market is equals to your nominal GDP. How much is my nominal GDP? 5.6. 5.6 plus percentage of profit by GDP. Percentage of change in profit divided by GDP. So the answer is 0. 0 plus GDP plus percentage change in PE. GDP plus sorry percentage change in PE. How much? 0. So what is the long term capital gain in equity market? It remains 5.6 only, because there is no support from the side of the profit and there is no support from the side of the private equity. Sorry, PE ratio. Clear? Next question is, what is the long term domestic market equity return? Domestic market equity return. So you will calculate it, capital gain plus dividends. These are the two forms of return to us. Either one through dividends, second one is the appreciation. Clear? So what is the capital gains? 5.6 from the equity market. How much is the dividend? 2.6. So what is the domestic equity market return? Is 8.2% overall. 8.2% overall. So now if I want to conclude something, okay, so high growth in capital investment does not always means that there is a high equity return, because sometimes growth is always factored into the stock price. Sometimes we say that now the moment the news comes, it is already factored in the stock price. So what if the high growth is already factored into the stock price? Then you will not get the return, the expected return. Clear? Sometimes investment grows faster than the output. Investment grows faster than the output, then it will leads to the lower return on the capital, and hence it will reduce the equity return. Clear? Like I'll give you one example. Suppose one country suddenly decide that they will increase their investment in building the real estates. Clear? So on paper investment growth is high, but if there is a oversupply of building, low demands, property prices will fall, companies will get lower returns, investor will lose the money even though economy invested heavily. So this is the reason growth based on heavy capital investment may not always give you the good equity return. Are you clear? Like if I tell you India's tech sector grows rapidly, but stock price have already increased because investor expected this growth. Clear? Then actual equity return will be low. Clear? So if I want to summarize the whole thing, that trend economic growth is the foundation of capital market expectation. It will affect your DCF forecast, your stock returns, your inflations, your monetary policies and bond yield. So forecasting the growth require looking at the labor, capital as well as the productivity, and the equity return in the long run. They move with the GDP growth, not with just the temporary boom. Clear? So this is very important topic for economists, for analysts as well as for the mutual funds manager, because it's all depends upon the economic growth. Clear? So I'll keep this much in this lecture, and then next lecture we'll move ahead with the further discussions. Thank you.